Money has a funny way of making smart people do silly things. I like to think of myself as a mostly rational guy. Someone who reads the manual before assembling the bookshelf and checks the expiration date on the milk. But put a hot stock tip in front of me 10 years ago and I turned into a golden retriever seeing a squirrel. I just had to chase it. It turns out I wasn't alone. We spend our whole lives learning how to earn money, grinding through school, negotiating salaries, maybe working a side hustle. But we spend almost zero time learning how to keep it, or better yet, how to make it grow without having a panic attack. I want to talk about that gap today. I want to walk you through the 3 absolute biggest investing mistakes I made early on. These aren't just textbook errors. These are the specific, slightly embarrassing blunders that cost me real time and real capital. The goal here isn't to make you feel bad if you've done the same thing. It is actually the opposite. I want to show you that these mistakes are almost a rite of passage, but they are also completely avoidable if you know what to look for. We are going to look at the psychology behind why we chase bad investments, the math behind why boring portfolios usually win, and the emotional roller coaster that ruins more retirement plans than any market crash ever could. If you have ever looked at your bank account and wondered why it isn't moving the way you want, or if you have ever panic sold something only to watch it skyrocket a week later, stick around. We are going to fix that mindset today. Think of this as a financial confessional booth, but with better lighting and hopefully a better return on investment. Before we get into the specific mistakes, we have to talk about what we are actually trying to do here. Most of us don't want a pile of cash just to swim in it like a cartoon duck. What we really want is freedom. We want the ability to say no to a boss we don't like, or the ability to order the guacamole without doing mental math. We want autonomy. The problem is that the financial industry is not really built to sell you autonomy. It is built to sell you activity. It wants you trading, moving, reacting to headlines, and buying the latest shiny object. That friction between your desire for calm, long-term wealth and the industry's desire for short-term noise is where the mistakes happen. I used to think investing was about picking the winners. I thought it was like horse racing, where if I studied the form guide long enough, I could pick the horse that would cross the line first. Spoiler alert, it is not horse racing. It is more like owning the racetrack. When you try to pick the winning horse, you are gambling. When you own the track, you make money no matter who wins. That shift in perspective took me years to figure out. I started out in a small apartment, convinced that one big trade would buy me a house. Instead, that mindset bought me a lot of stress and a very valuable lesson in humility. So, as we go through these 3 mistakes, I want you to check your own pulse. See if any of these sound familiar. Maybe you are the type who loves the thrill of the chase, or maybe you are the type who freezes up when the market drops. We all have a default setting. Recognizing yours is the first step to overriding it. Let's dive into mistake number 1, which is the classic trap of chasing high returns without a plan. This is the investing equivalent of grocery shopping while you are starving. You end up with a cart full of junk food that looked amazing in the moment but offers zero nutritional value and leaves you with a stomachache. For me, it started with tech stocks, but for others, it might be cryptocurrency, meme stocks, or whatever the neighbor is bragging about. The psychological trigger here is social proof. You see your friend, let's call him Dave, posting about his 200% gains on some obscure coin or company. Suddenly, your steady 7% return on an index fund feels like an insult. You feel like you are losing by not playing his game. This is FOMO, fear of missing out, weaponized against your wallet. I remember pouring money into a company simply because everyone on a forum was talking about it. I didn't read their balance sheet. I didn't know their profit margins. I just saw the line going up and I wanted to be on the ride. The problem with buying something just because the price is rising is that you are usually buying at the peak of optimism. That is the moment when there is no one left to buy, which means the only direction left to go is down. When that inevitable crash happened, I didn't have a plan. I didn't know why I owned it, so I didn't know when to sell. I just watched the value melt away like ice cream on a sidewalk in July. It wasn't investing, it was hope. And hope is a terrible hedge fund manager. The fundamental issue wasn't that the asset was risky, it was that I had no strategy. I was driving a car with a blindfold on because I liked the sound of the engine. There is actually some biology at work here. When you see a high-flying stock, your brain releases dopamine. It anticipates the reward. It imagines the vacation you will take with the profits or the car you will buy. That chemical rush is powerful, and it overrides the logical part of your brain that asks boring questions like, does this company actually make money? It is the same mechanism that keeps people at slot machines. I fell for it hard. I looked at past performance and assumed it would continue forever. This is called recency bias. We think the future will look exactly like the immediate past. If a stock went up yesterday, we assume it will go up tomorrow. But markets are mean reverting. That is a fancy way of saying that things that go up super fast usually come back down to reality eventually. When you chase returns, you are usually buying the hype, not the value. You are paying a premium for the excitement. Real investing, the kind that builds generational wealth, is usually pretty boring. It is watching paint dry. If you are getting an adrenaline rush from your portfolio, you are probably doing it wrong. I learned this the hard way when my sure thing investment dropped 40% in a month. I realized then that I wasn't an investor. I was a speculator. An investor asks, what is this worth? A speculator asks, what will someone else pay for this tomorrow? Those are two very different questions. If you don't know the difference, the market will charge you a very expensive tuition fee to teach you. I paid my tuition, and trust me, I would rather have kept the cash. So how do we stop chasing the shiny objects? We need a plan that acts like a seatbelt. The first step is setting specific financial goals that have nothing to do with beating the market. If your goal is make as much money as possible, you will take too much risk. If your goal is retire in 20 years with $1.5 million, you can work backward to see exactly how much you need to save and what rate of return you actually need. Usually, you don't need to find the next Amazon to hit your goals. You just need to be consistent. I started writing down my investment thesis for every single buy. It's a simple rule. I cannot click the buy button until I write down 3 sentences on why I am buying this and under what conditions I would sell it. Because Dave said so is not a valid thesis. This little pause creates a gap between the emotional impulse and the action. It forces the rational brain to clock in for work. Another strategy is the sandbox rule. If you really have the itch to trade individual stocks or crypto, limit it to 5% of your portfolio. Treat that money as gone. If it goes to zero, your financial life is fine. If it moons, great, you buy dinner. But never let the speculative play become the main event. Most of your money should be in boring, reliable assets that you understand. Never invest in something you can't explain to a 10-year-old. If you can't explain how a crypto protocol works or how a biotech firm makes money, you have no business owning it. That rule alone would have saved me thousands of dollars in my 20s. Boring is beautiful. Boring pays the rent. Moving on to mistake number 2. The lack of diversification, or as I call it, the one basket illusion. When I first started, I thought I was diversified because I owned 5 different stocks. The problem? They were all tech companies. I had a chip maker, a software company, a computer manufacturer, and an internet service provider. In my head, these were different businesses. In the market's eyes, they were all one bet, the technology sector. When the tech sector took a hit, my entire portfolio went down in unison. It was like watching synchronized swimming, but instead of elegance, it was just my net worth drowning. This is called concentration risk. You are betting everything on a single outcome. Even if you own different companies, if they all rely on the same economic factors, like interest rates or consumer spending, they will often move together. That is correlation. High correlation means your assets are holding hands. When one jumps off a cliff, the others follow. True diversification means owning things that hate each other. You want assets that move in different directions. When stocks are zigging, you want something else, maybe bonds or real estate, to be zagging. Or at least staying flat. I didn't understand this. I thought diversification meant owning a lot of stocks. But if all those stocks are large US companies, you aren't diversified, you are just complicated. You are exposed to the US dollar, the US economy, and US regulations. If something happens to any of those, you have nowhere to hide. I learned this when a specific sector correction wiped out gains I had spent 2 years building. I realized I had built a house of cards, and I was shocked when a breeze knocked it over. Let's get real about geography for a second. Most of us have a home bias. If you live in New York or Dallas, you probably invest mostly in US companies, because that is what you know. You see the brands at the grocery store, you use the services. But the US stock market is only about 60% of the global market. By ignoring the rest of the world, you are missing out on massive opportunities and taking on extra risk. What happens if the US economy slows down, but emerging markets take off? If you are 100% US, you miss that boat entirely. I made the mistake of thinking the US was the only game in town. True diversification is uncomfortable because it means you always have something in your portfolio that is underperforming. If you look at your investments and everything is going up, you are not diversified. You are just lucky, and luck runs out. You should have a part of your portfolio that makes you say, "Ugh, why do I own this?" Maybe it's international bonds or value stocks. But that ugly duckling is exactly what saves you when your darling tech stocks crash. It is the umbrella you carry on a sunny day. It feels useless until the storm hits. Then, it is the most valuable thing you own. I used to hate seeing red in my portfolio. Now, I realize that if I see a little bit of red and a lot of green, it means I am probably balanced correctly. I am prepared for different economic weathers. It is about survival. If you can survive the bad times without having to sell, you win. Concentration gets you rich quick, but diversification keeps you rich. I prefer keeping rich. So how do we actually fix this without needing a PhD in economics? The simplest rule I follow now is the 10% rule. I never let any single company take up more than 10% of my total portfolio. Honestly, 5% is even safer. This ensures that if Enron happens, if a massive company goes to zero overnight, my financial life isn't ruined. It stings, sure, but I'm not moving back into my parents' basement. To achieve this easily, I use broad market index funds, or ETFs. Instead of trying to buy the needle, I buy the haystack. An S&P 500 fund, or a total world stock fund, gives you instant ownership in thousands of companies across different sectors. It is diversification in a box. You pay a tiny fee, and in exchange, you eliminate the risk of a single company destroying your wealth. You still have market risk. The whole market can go down, but you don't have single stock risk. I also make sure to rebalance. Rebalancing is the vegetable eating of the investing world. It's not fun, but it keeps you healthy. If your tech stocks go up huge and now make up 80% of your portfolio, you have to sell some winners and buy the losers, maybe bonds or international stocks, to get back to your target. It feels counterintuitive to sell what is winning and buy what is losing. It feels wrong. But that is the mechanical way to buy low and sell high. You are forcing yourself to take profits and buy undervalued assets. It removes the emotion and keeps your risk level constant. It turned my portfolio from a roller coaster into a cruise ship. Still moving, but much less likely to make me throw up. This brings us to the third, and arguably the most dangerous mistake: making emotional decisions and ignoring risk. This is the subtle trap. It isn't about the math, it is about the mirror. The biggest threat to your portfolio is usually staring back at you in the reflection. I used to think I had a high risk tolerance. I told myself, sure, I can handle a 30% drop, no problem. Then the market actually dropped. And let me tell you, a 30% drop on a spreadsheet feels very different than a 30% drop in real life. When you see thousands of dollars vanish in a week, your primitive brain screams, danger! It initiates the fight or flight response. In investing, flight means panic selling, and that is exactly what I did. I sold at the bottom to protect what I had left. I turned a temporary paper loss into a permanent real loss. Then, of course, the market rebounded a month later, and I was sitting on the sidelines with cash, afraid to get back in. I bought high, sold low, and missed the recovery. It was the trifecta of failure. This happens because we don't understand volatility. We view volatility as risk, but volatility is just the price of admission for high returns. It is the turbulence on the flight. You don't jump out of the plane just because there is some turbulence. But without an emotional seatbelt, that is exactly what we do. On the flip side, greed is just as dangerous. When things are going well, we get overconfident. We think we are geniuses. We start taking silly risks, buying on margin, or neglecting our savings because the market will provide. That overconfidence usually peaks right before a correction. The market has a nasty habit of humbling you exactly when you think you have figured it all out. To avoid this emotional whiplash, you have to define your risk tolerance before the crisis hits. It is like a fire drill. You don't wait until you smell smoke to figure out where the exit is. You need to know your sleep well at night number. If checking your portfolio makes you anxious, you are taking too much risk. Dial it back. Maybe you need more bonds. Maybe you need more cash. There is no shame in having a conservative portfolio if it means you will actually stick with it. The best portfolio is the one you can hold on to when the world feels like it is ending. Another crucial part of risk management is the emergency fund. This isn't an investment, it is insurance. I made the mistake of investing every single dollar I had. When my car broke down, because cars smell money, I had to sell stocks to pay for the repair. Naturally, the market was down that week, so I took a loss just to pay a mechanic. If I had kept 3 to 6 months of expenses in a boring, high-yield savings account, I wouldn't have touched my investments. The emergency fund creates a buffer between your life and your portfolio. It allows your investments to grow uninterrupted. Never invest money you will need in the next 5 years. The stock market is a great place to grow wealth over decades, but it is a terrible place to store your rent money. If you need the cash for a down payment or a wedding next year, keep it in cash or equivalents. The risk of a short-term drop is just too high. Understanding this timeline is what separates gambling from planning. The ultimate hack to remove emotion is automation. Humans are terrible at timing. We are emotional, biased, and easily distracted. So, I fired myself. I set up automatic transfers from my checking account to my investment account every single month. It happens the day after payday. I don't see the money, it just goes to work. This is called dollar cost averaging. When the market is high, my fixed amount buys fewer shares. When the market is low, my fixed amount buys more shares. I am automatically buying more when things are on sale without having to summon the courage to do it. It takes the decision-making out of the loop. I don't have to look at the news. I don't have to wonder if now is a good time. The answer is always yes, because I am buying for 20 years from now. This consistency beats brilliance every time. It also frees up a lot of mental bandwidth. I don't stress about the daily fluctuations because the system is running itself. It is like a slow cooker. You throw the ingredients in, set it, and walk away. You don't open the lid every 5 minutes to check on the stew. That just lets the heat out. Investing is the same. Set it up, automate it, and go live your life. Your future self will be rich, and your current self will be happy. It turns investing from a source of stress into a background utility, like electricity or water. It's just there, working for you. Looking back, I don't regret these mistakes. Well, I regret the money I lost, sure, but the lessons were worth more than the capital. Every investor faces these traps. You cannot read a book and become a perfect investor, any more than you can read a book about swimming and qualify for the Olympics. You have to get wet. You have to choke on a little water. The difference between successful investors and the ones who quit isn't that the successful ones never mess up. It is that they learn. They adapt. They don't blame the market, they analyze their process. I started keeping an investment journal. I write down why I bought, why I sold, and how I felt. Reading back through it is hilarious and horrifying. You see your own biases in plain English. You see yourself getting greedy. You see yourself getting scared. That self-awareness is your edge. Wall Street has algorithms and supercomputers. You have self-control. If you can master your own behavior, you can beat the professionals who are forced to chase quarterly returns. Investing is a marathon, not a sprint. That is a cliché because it is true. If you trip at mile 2, you don't lay down on the pavement and give up. You get up, brush off your knees, and keep jogging. The power of compounding needs time to work. The biggest compounding happened in my knowledge base, not just my bank account. Every loss made me smarter. Every panic sale made me calmer the next time around. If you are just starting out, or if you are in the middle of a learning moment right now, give yourself some grace. You are building the mental muscles you will need to manage a much larger portfolio down the road. One major upgrade to my process was changing my information diet. I stopped watching the 24-hour financial news channels. Those channels are designed to keep you glued to the screen with breaking news banners and red tickers. They sell anxiety. They don't help you invest. Instead, I started reading books by the giants of the industry, people like Jack Bogle or Howard Marks. I joined communities that focused on long-term strategies rather than to-the-moon rocket emojis. Who you listen to shapes how you think. If you hang out with day traders, you will start thinking like a day trader. If you hang out with long-term investors, you will start thinking in decades. It is important to curate your inputs. I also learned to distinguish between signal and noise. A daily price drop is noise. A fundamental change in a company's business model is signal. Most of what we hear is noise. Learning to ignore 99% of the financial news was the most profitable thing I ever did. It gave me clarity. It allowed me to stick to the plan when everyone else was losing their heads. You have to build a fortress around your mind. The market will try to breach the walls with fear and greed every single day. Your plan, your diversification, and your risk management are the guards at the gate. Trust them. Don't open the gate just because a guy on TV is yelling. So, here is the bottom line. Investing success does not come from flawless predictions. I cannot predict the market, and neither can the guy in the suit on CNBC. Success comes from the cumulative result of avoiding the big mistakes. It is about not blowing up. If you can avoid chasing hype, avoid putting all your eggs in one basket, and avoid panic selling, you are already ahead of 90% of investors. It is a game of subtraction. You win by removing the errors. You build wealth by being consistently average for a very long time. That sounds uninspiring, but consistently average in the stock market turns a few $1,000s into a retirement fund. The magic of compounding does the heavy lifting for you. All you have to do is not interrupt it. You have to be the patient gardener. You plant the seeds, you water them, and then you wait. You don't dig them up every day to see if the roots are growing. You trust the process. My journey from a chaotic, FOMO-driven speculator to a calm, diversified investor took years. Hopefully, by hearing this, you can shortcut that process. You can skip the losing money phase and go straight to the building wealth phase. That would be a pretty good trade. Start now, not tomorrow, not when the market looks better. Start now with whatever you have, even if it is just $50. The habit is more important than the amount. Open the account, buy the broad index fund, set up the auto transfer. Then go do something else. Go for a walk, read a book, call your mum. Live your life. Your money should serve your life, not consume it. If you are spending more time worrying about your investments than enjoying the freedom they are supposed to provide, something is wrong. Revisit your plan. Check your risk tolerance. And remember that every seasoned professional you admire has made these exact same mistakes. They just didn't quit. That is the secret. Resilience, curiosity, and a little bit of humility. Your future self is going to thank you for the resilience and wisdom you are gaining right now. They will thank you for the compound interest, sure, but they will mostly thank you for the peace of mind. So, I want to hear from you. Drop a comment below. What is the one financial lesson you learned the hard way? Or, if you are brave, tell me your "I bought a stock because Dave said so" story. Let's normalize talking about the losses so we can all get better at the wins. Side effects of this approach may include calmer Sunday nights and a distinct lack of panic when the news gets scary. Thanks for hanging out, and here's to making new, better mistakes.